Hi guys, it's your host Ted. Let's get this party started today. And today we are going to be talking about backtesting 101, the complete guide, right? Now, this is the key topics that we are going to take and the key takeaways behind it. Now, let's talk about the phase one. What actually is backtesting? What do we mean by backtesting, right? So, backtesting is the process of testing a trading strategy on historical data to check and evaluate how it performed in the past, right? If it was profitable, it was loss making, or if it did actually have alpha generating capabilities. Now, why do we backtest? We backtest to validate hypotheses before risking real capital. We quantify our edge to check if there was actually alpha significance in our model or it was just pure noise, right? Now, another thing, we backtest to understand the risks involved in the model. So what do I mean by risks? We have talked about fat tail events. So, what are fat tail events? Like events that are not predictable, like 2020 crash and 2008 Lehman Brothers crash, or any geopolitical war or any earthquake, right? Now, what do we do in backtest is sometimes we actually optimize the parameters, but we have to optimize the parameters in constraints very carefully, because if we are not careful in optimizing the parameters, our strategy will be overfitted, and overfitted is the killer of any strategy in live markets. So let's say you overfitted your strategy, and if you're trying to run it, absolutely you are going to have losses in demo trading and in live trading, right? It also helps us build the confidence to know, our strategy survived 2020, our strategy survived 2008. Now, what backtesting does not guarantee? It does not guarantee profits. It does not guarantee you a curve fitting, right? If your strategy only works on a specific market regime, a specific data set, it's curve fitted. It's not a replacement for forward testing as well. Now, what do I mean by forward testing? Paper trading or live validation. Now, how does a backtest pipeline actually look? First of all, we collect historical data. There is L1, L2, L3 data. Being a retailer, I suggest you only keep it to L1 data. There is a OHLCV, open, high, low, close volume, right? Cleaned and adjusted. We're going to talk about what do I mean by clean and adjusted as well. Now, once your data is processed and handled properly, it goes through your logic, and that logic produces buy and sell signals, and that signal is converted into position sizing, right? Plus one, zero, minus one, or fractional means like if you were risking 2%, you are, due to some market regime changes or high volatility changes, you are only risking 0.5, just a case, right? Then we apply costs and slippage, and then we evaluate the metrics like sharp ratio, drawdown, Kaggle, win rate, Calmer, Sortino. There are a lot of things to calculate. Yeah. Now, let's talk about the key terminologies involved: signal position, equity curve. Equity curve is basically the line that you see going up if your strategy is profitable. Drawdown is basically if this was your peak of equity, how much did your how much money did you lose from the peak of in your strategy. Sharp ratio in sample out sample, walk forward, right? Now, this is the setup of how you actually import and configure. Then we talk about phase two. What are the common biases? How your backtest can actually lie to you, right? So just like law, every backtest is guilty until proven innocent. The following biases can inflate your results and give you false confidence into your strategy. Now, the first one being look ahead bias. Now, what do I mean by look ahead bias? Let's say your model is taking a trade on 2021. If your model has look ahead bias, it already knows the data that's actually what's going to happen in 2024, 2023. So that's look ahead bias. It's basically using today's close to generate another thing, especially about look ahead bias. Let's say your model was going to generate a signal on candle n, right? Now, when the candle N closed is when a signal was generated. So your actual position should be entered on N plus 1, right? Opening of N plus 1. But instead, what will happen is the model will have look ahead bias and it will open the position in nth opening. So basically, even before your signal was generated, it is already entering, going back, like it's working like a time machine and going back and entering a position. Then using adjusted prices that were revised after the fact, using corporate data, splits, dividends before they were announced, calculating indicators using the entire data set instead of an expanding window. These are the code examples of what a look ahead bias does look like. Then the golden rule is always shift your signals by one before multiplying the returns. Now let's talk about survivorship bias. What do I mean by survivorship bias is, let's say you're testing S&P 500. So if you're using only the constituents and only the stocks or tickers that are currently in 2026 are in S&P 500, and you are ignoring the stocks that have been delisted in the past 10 years, 20 years, let's say Lehman Brother if you're not including, and everything like that, right? Enron is there, WorldCom is there. If you're not including them, it's just like you are choosing the survivors, right? You are choosing the stocks that survived the tsunami. But well, that's not fair, right? You have to include the companies that went bankrupt, delisted, or acquired, or that were removed from the index. Now, how big of a bias can this create in your backtest? If you check in mutual fund returns, it could be only a 0.9% effect. If you check in hedge fund returns, it could be a 1.5% per year difference. And in general, equity backtest, it can lead to 1 to 3% per year depending on the universe. Now, how to mitigate it? We can use point in time data, like which stock was actually being traded in 2010 or 2020 in S&P 500, include delisted returns at minimum, acknowledge the bias and discount your results accordingly, right? If you are unable to get the data. Now let's talk about overfitting. Your strategy, memorize the past instead of learning from it. Overfitting happens when you test too many parameter optimization, specifically grid searches and hyperparameter optimization, and choose the one that yielded the best results, right? Let me give you an example for this. Let's say SMA 21 over 36 yielded the most returns in the past 20 years. But how would you have known 10 years ago that it will yield the best returns, right? If you start choosing, if you start using the best parameter that work the best on the entire data set in the last 20 years, you're just overfitting, right? It does not guarantee that 21 and 36 will work in the future. Let's say a few months down the lane, what if 20 and 40 are working the best, right? So that's a clear case of overfitting, and you will be losing money thanks to that. And adding too many rules and filters that perfectly align with your historical data is also overfitting. Optimizing on the same data you used to evaluate, so basically not doing a split test or walk forward, right? The overfitting test, commonly what you can do is, what would this strategy work on different assets that show similar asset behavior? Would it work in a different time frame? Can you explain the economic rationale or the hypothesis behind it? How many parameter combinations did you try? More tries is equal to more chances of overfitting. The multiple testing problem is, if you test 100 strategies on the same data, 5 will appear significant at the 5% level purely by chance, right? Then data snooping, repeatedly peeking at the same data set to refine your strategy. So even if you don't explicitly optimize, every time you are looking at a chart and thinking, what if I added a filter here? What if I had a position here? Tweaking a threshold because the equity curve looked bad in one period, removing a losing trade by adding a new one. You are overfitting to data. Your brain is the optimizer, right? It's all in here. Everything that can create a good strategy is right in here. You have to train this, help it with conceptual knowledge in quantitative finance, right? Now, how you can mitigate data snooping is, lock away 30% of your data as hold out data set, use walk forward analysis, or report number of trials alongside your results. Then some people avoid using transaction cost, right? So if you're like trading, if your model is taking, let's say, 10 trades a day, it's bearing a lot of commission, slippage, everything. And if you're not including it, and your backtest is profitable, but in reality including those transaction costs will make you lose money, right? Now this is a summary of biases. Now I will show you the graph. So this is S&P 500 buy and hold. As you can see, bias No shift is always generating 1 to 3% more returns than actual what your actual model would have generated. Now, how do you actually prepare the data, right? Because data preparation is also very important. Otherwise, you will have phantom spikes, phantom losses, right? Now, good data is the foundation of every backtest. What is OHLCV? It's open, high, low, close volume, adjusted versus unadjusted prices. So what do I mean by unadjusted prices? Raw prices as they were traded and on that day. But adjusted are retroactively modified to account for splits, dividends, and rights issues. Always use adjusted cloud for backtesting return. Unadjusted can create fake gap on split dates. Now, data quality test, what you should do is check if your data has any missing dates, any NaN value, no zero or negative prices should be there, no duplicates timestamp should be there. Prices should be split adjusted. Let's say a stock of $400 was split in 1:4. Right now the stock will be trading at $100. What your model will see that all of a sudden your stock fell down by 75%, but that didn't actually happen, right? It was split. Now volume is reasonable, no zero volume days for liquid assets. Now how you can do this? One of the things that you can do is train split test. So if you had let's say 2015 to 2024, right, 9 years of data, what you could do is use 70% to develop your strategy, fine tune the parameters 2015 to 2025, and use 2020 to 2024 as your out of sample data where you validate. Let's say you created XYZ strategy here, it's working here, but you need to validate it, right? Now, how will you validate? You will run it on 2020 to 2024 and actually see if there was significant degradation in the strategy. If there was not significant degradation in the strategy, your strategy is robust. And what you could actually do is before 2015, you could also take 3 years, 5 years as hold out data. Again, it will be your auto sample data where you will validate your strategy on different market regimes. Rules: never shuffle time series data. Auto sample must be most recent data. Simulates real deployment. Once you peak at out of sample, it becomes contaminated. You can't unsee it, right? This is how a CSV file would look like. This is the data quality report that you should actually have while handling your data, right? Now, the SPY price with train test. So as you can see, this was used to train the model and this was used to test the model, right? This is the dotted line which shows a split in data set. Now, building a strategy, very basic SMA crossover, the most classic and simple trend following strategy which does not work in modern times. Buy when fast SMA crosses above slow SMA and sell when the fast SMA crosses below slow SMA. But what if market is mean reverting? You will have constant losses. Again, useless strategy, but just using it for example. Why SMA? Again, not the best, but best teaching tool and easy to understand, easy to code. Demonstrate all backtest concepts, right? Now, as you can see right here, SMA 20 and SMA 50, buy signal, sell signal, buy signal and sell signal was too late, then again buy signal, sell signal, made profit, buy signal, sell signal, made profit. But as you can see in whipsaws and mean reverting markets, you'll be making huge losses. Now, this is the result against buy and hold, and you definitely want to beat buy and hold at the bare minimum, right? As you can see, it did produce almost half of the half of the return that buy and hold did generate. Now let's talk about phase 5, the performance metrics. What performance metrics you should look out for? I think I've included this in stats and metrics video, but still we will go through this, right? CAGR is very important. Analyze volatility, Sharpe ratio, Sortino ratio, maximum drawdown, Calmer ratio, win rate, and profit factor, right? Now, what do each of these mean? CAGR we use 252 days. Why? Because there are approximately only 252 trading days per year, which tells you the real annualized return, not 365 days are used. Measure risk. Higher volatility is equal to more uncertainty in the market. There are higher chances of you making a huge profit or a huge loss. Then Sharpe ratios is the gold standard metric, returns per unit of risk. A sharp above 1 is decent, a sharp above 2 is excellent. Now, Sortino, like sharp but only penalizes downside volatility. Upside volatility is good according to Sortino. This is maximum drawdown, we have talked about it. Now, Calmer is return per unit of maximum pain, which is the absolute maximum drawdown. Higher is better. Profit factor above 1 means you are making more money than you are losing. Now, these are the performance comparison. As you can see, we have talked about skewness, kurtosis, everything in the stats and parametrics. You can check it out as well. Now, this is the graph equity curve underwater plot, and this is again your buy and hold underwater plot. This is monthly return heat map, basically how much returns or losses you made in each month in the entire backtest. This is your rolling 1 year Sharpe ratio. Now, let's talk about transaction cost and slippage, why it matters a lot. Commission is $0 to $5 per trade, broker fee per trade. Spread is always there, bid ask spread on basically the difference between the buyer and the seller at a particular point of time. Slippage, price movement between your signal and execution, right? Market impact, if you are trading with millions and billions of dollars, your position sizes will move the markets, and it will make sure that your reality returns are less than what you expected. This is the formula for these are the realistic cost estimates for everything, right? Now, if you see here, if we, in especially strategies that actually do trade a lot every day, or let's say every week, this is the result. As you can see, 0 bps basis point, sorry, it is creating a massive 85% return, 0% cost drag. But if you add 50 bps to every trade, your cost drag becomes 21.5%. So in reality, you might be making 1% less profits if you are actually considering the cost. Now, what do you mean by walk forward optimization and sampling optimization, out of sampling sample testing? So the problem with a single split is that a single split gives you one data point of out of sample performance. That's statistically insignificant. You might have gone lucky from which year you might have split the data. That's why, to validate and make sure your strategy is robust, you use walk forward analysis. What it will do is it will train on A to B, right, and then test on B to C. Then somewhere it will create a step in window 2, and let's say A, between A and B, it will create a A2 to B2 and then test to C2, right? As you can see, it's creating steps, right? Training, testing, training, testing, training, testing, train. You could create 50, 20, 10, any number of windows to test upon. It basically slides forwards on the data and repeats the test. Now, there are 3 parameters used in walk forward. First is train days, second is test days, and third is step days. Your walk forward efficiency is calculated out of sample Sharpe divided by in sample Sharpe. This is basically how your dashboard should look like, right? If you are backtesting a strategy, this is walk forward out of sample. Out of sample is basically the data that was tested upon, not trained upon, right? In sample versus out of sample Sharpe by window 1, window 2. There are 13 windows included here, right? Now, let's talk about Monte Carlo and statistical validation. Why do we actually use Monte Carlo? First of all, I've said this before as well, Monte Carlo is a bit overrated, because if you are testing a overfitted strategy, Monte Carlo will show 100% success probability in endless number of simulations, which is again false. Why? Because your original strategy was overfitted. Even if you're shuffling the trades, it will still make huge profits and show you a unrealistic profit, right? Now, a single backtest gives you one possible path, whereas history could have unfolded in endless possibilities, right? I will give you an example for this, like I gave it on my Discord to a member, right? So consider it like this: me, Ted, right? I'm living in, let's say, universe 1, right? Let's say there were infinite timelines, infinite branches of Earth, and if I was testing to find a billionaire Ted in, let's say, 50,000 of those Earths, there is a possibility, right, there that there might be a billionaire bunch, and there might be a homeless Ted, right? So we have to consider the best possible paths, the worst possible paths, and using Monte Carlo, you are generating thousands of alternative paths. You could use 5,000, 10,000, 2,000, 1,000, 25, 50, 100,000, entirely up to you. It will give you to understand the range of outcomes you could expect. What's the probability of you actually hitting your targets, and what's the worst case scenario at any specific point of time. Now, there are three main methods: shuffle returns, right? You shuffle the daily returns and rebuild the equity curve. Block bootstrap, shuffle blocks of consecutive days, right? Take 3 days and put it at the end, and take somewhere in the middle a few days and put it where you. So it will partially preserve the autocorrelation structures, right? And random start dates, start the backtest at random dates of the backtest to check if you made so much money because you started live trading it on XYZ specific days. The confidence intervals, I will show you. This 50th percentile is your mean line, what you could have expected with your current data set, right? This is the 25th, this is the 5th percentile. 5th percentile is basically your 5% best case scenario. 95th, oh, this is sorry, the 95th. This is the 5th percentile, basically your worst case 5% scenarios. And then this is the distribution on histogram, distribution of maximum drawdown. These are the results, right? Now let's talk about putting it all together into one engine, phase 1 to 8, into a reusable production grade backtest. First is, it should fetch and clean your data properly, accept any signal function, apply transaction cost properly according to the asset you are modeling, calculate our metrics, generate a full visual report, support forward validation, and runs Monte Carlo simulation, right? This is how a backtest report should look like. This is the equity curve, this is the drawdown underwater plot, monthly returns, daily return distribution, rolling sharp, and the detailed statistics, right? And this is on QQQ, same report. Now, key takeaways before we end: the backtesting principles, commandments that you should always follow: always shift signal by 1 day, include transaction cost no matter what, use walk forward validation to ensure your strategy is profitable, run Monte Carlo, run the number of trials. If you tested 100 combos, accept it and say it so when you're prompting AI to vibe code it for you and validate the strategy for you. And know your biases, if and what biases you're including: survivorship, snooping, cost, neglect. Economic rationale first. You should always have a clear justification of what you're trying to accomplish and how you're trying to accomplish. If you can't explain why it works, it probably doesn't work in the real life, right? Auto sample is sacred. Once you peak, it's contaminated. Sharp is more important than returns. Never optimize for returns, always optimize for sharp ratio or calmer ratio. Backtest is your step one, then always paper trade, then live trade with small size, and then scale. What's next? Apply the backtest engine to your own strategies, experiment with different signals, add more asset, test cross asset robustness, implement walk forward optimization, and graduate to intermediate tier for advanced signal generation, right? Now guys, this is built for the TED's Quant cohort from zero to a systematic trader. Thank you so much for your time today. I hope it was a meaningful lesson for you guys, and more to come soon. All right, bye bye. Thank you so much.